Your home, your biggest investment, just became riskier. The CFPB, the agency that's supposed to protect homeowners from predatory lenders and unfair practices, is on the chopping block. In 2008, when the real estate market crashed, I was in the trenches working with homeowners who suffered the aftermath of this event. I know exactly what a world without financial protections looks like, and I don't want to see that ever happen again. It wasn't pretty. If you're a homeowner or you want to become one and you're concerned about big banks making homeownership and just day-to-day life unaffordable, or worried about seeing another crash that resulted in 8 million job losses and 4 million people losing their homes, this should matter to you. And today I'm going to cover what the CFPB does, the dangers of losing it, the arguments of dismantling it, and how you will be impacted and how housing will be impacted. Stay with me because in just a few minutes, you'll know exactly what's changing and what this means for your home finances and future. The Consumer Financial Protection Bureau was launched in 2011. It was created following the 2008 financial crisis as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act, which was signed into law in 2010. Congress designed the CFPB to oversee financial institutions, enforce consumer protections, and ensure fairness in lending practices. Recently, Trump's administration is working to shut the CFPB down. The person in charge of this agency has already been told to stop investigations, pause new rules, and shut down its work. Even Elon Musk has publicly said the agency should be deleted. This has sparked huge debate. Trump's critics worry that without it, banks and lenders could exploit consumers with hidden fees and unfair practices. But some say removing the CFP will make it easier and cheaper for businesses to offer loans and other financial services. Therefore, these changes could directly impact your mortgage and your credit cards, and even how much you pay in fees. The big question is, who benefits from shutting this down? You, politicians, or big banks? Critics of shutting down the CFPB argue it could lead to serious consumer risk. And here's why. Without the CFPB keeping financial institutions in check, banks and lenders could bring back deceptive practices, including hidden fees, misleading ads, and unfair loan terms. In 2018, the Federal Trade Commission, FTC, sued Lending Club Corporation for falsely promising loan applicants they would receive a specific loan amount with no hidden fees. In reality, Lending Club deducted hundreds or even thousands of dollars in hidden upfront fees from the loans. The CFP's action against Lending Club resulted in more than $17.6 million being refunded to consumers who were harmed by these deceptive practices. If you're scammed or treated unfairly by a bank or lender, the CFPB steps in to investigate and help you recover your money. Without it, resolving disputes could become much harder for you to recover money or fix credit report mistakes. As of January 30th, 2025, CFPB enforcement actions have resulted in $19.7 billion in consumer relief. An estimated 195 million consumer accounts have been eligible to receive relief from CFPB's enforcement and supervision work. The CFPB has imposed approximately $5 billion in civil money penalties on companies that violate consumer protection laws. The CFPB has worked to limit excessive overdraft and late fees. Without these protections, banks may reinstate high fees, costing you more. Since the CFPB cracked down on overdraft and NSF fees in 2022, banks' revenue from these fees have dropped $6.1 billion per year, a 50% reduction, saving overdrafting households about $185 annually. Before, consumers could rack up over $100 in an overdraft fees in a single day. But under new rules set for October 2025, big banks would have to cap the fees to $5 per day or charge only what it costs them. That's a huge difference, $35 per overdraft versus $5, which could help prevent debt cycle. However, with the pause and possible shutdown, this change is now uncertain. CFPB has pressured credit agencies to correct errors and remove unfair items like medical debt. If it's shut down, fixing credit mistakes could become a bigger challenge for us. It has pushed for limits on how companies sell personal information, including social security numbers. Without it, consumers could be vulnerable to data misuse and identity theft. The CFPB was created after the 2008 financial collapse and to prevent deceptive lending that led to mass foreclosures and job losses. Some fear that without it, history could repeat itself, and this means some believe that we may see 2008 massive recession happen again if the agency shuts down. The CFPB acts as a watchdog, protecting consumers from financial institutions that might take advantage of them. The arguments are that without it, consumers could face more risk, fewer protections, and higher costs, often with very little recourse. But there are others who believe differently. If the CFPB were to shut down, some argue it could be a good thing. And here's their argument. Critics argue that the CFPB operates without proper checks, bypassing Congress and acting independently. This gives it a broad control over financial companies, allowing it to enforce rules without any accountability. Some worry it could push regulations without considering congressional priorities or the public input. Without budgetary oversight, the CFPB may feel free to pursue aggressive policies, potentially leading to overregulation or rules shaped by political agenda. Since it doesn't go through the usual budget process, its rules could be seen as extreme or lacking broader consensus. It is bad for smaller businesses. Many believe the CFPB makes it harder for financial institutions, especially smaller ones, to offer services. Strict regulations can limit access to loans and credit, particularly for lower income individuals and those in rural areas, often the ones that need them the most. A study by the Consumer Financial Protection Bureau itself illustrates this point. Consumers in lower income neighborhoods are 240% more likely than those in higher income areas to become credit visible due to negative records. What this means is that people in lower income areas are much more likely to start their credit history with bad records, like unpaid bills or court debts. About 27.1% of them first appear on credit reports this way, compared to only 7.9% in the higher income areas. This makes it harder for them to get loans, credit cards, or mortgages in the future. This statistic highlights how stricter regulations can inadvertently make it harder for lower income individuals to establish a positive credit history. CFPB can result in higher costs for consumers. Regulations don't come free. Businesses must spend money to comply, and those costs get passed down to the consumers through higher fees on loans, credit cards, and banking services. Opponents argue the CFPB is redundant. Other agencies already exist. Agencies like the Federal Trade Commission, the FTC, Federal Reserve, and FDIC already oversee aspects of the banking practices and deceptive financial practices. Other mechanisms, market competition, consumer advocacy groups, and media scrutiny also play roles in keeping practices in check. Many individual states have their own consumer protection laws against unfair practices and fees, making federal agencies like the CFPB potentially redundant and just complete waste of resources. For example, the Federal Trade Commission, FTC, has long been responsible for consumer protection. In 1967, the FTC released a Model Unfair Trade Practice and Consumer Protection Act, which was adopted by the states. This demonstrates that the consumer protection frameworks existed and were effective prior to CFPB's creation. All 50 states have Unfair Trade Practices Act statutes. States can independently enforce federal consumer protection laws. Some states have even incorporated abusive practices in consumer protection laws, mirroring the CFPB's approach. Some regulations, though well-intended, can unintentionally harm consumers. Stricter rules may make it harder for low-income individuals to access credit cards, loans, and mortgages. The CFPB's policies could push them towards riskier, unregulated alternatives. For example, overdraft protection rules might make it tougher for people to restore their accounts, leading banks to remove overdraft options altogether. This could result in immediate account closure due to negative balances, or make it harder to open new accounts in the future. Critics argue these are heavily lopsided regulations. The CFPB focuses too much on punishing financial companies without recognizing the positive service they provide. They argue that more balanced approach would be more beneficial to everyone. Regulations can discourage new financial companies from entering the market, leading to less competition and fewer choices for consumers. Shutting it down could open up more competition among lenders. More competition means more options and competing offers that benefit you. Without the CFPB's restrictions, innovation in the financial industry might thrive. Check out this chart. It shows how the number of banks has been shrinking since the 1980s and 1990s, driven by interstate banking reforms and the 2010 Dodd-Frank Act reform. That's why giant banks like Chase, Wells Fargo, and Bank of America keep swallowing up smaller ones. Big corporations love regulations because they reduce competition, give more power to the biggest players. For you, this means less personalized service, bigger financial risk for the country, and one-size-fits-all banking product. Except there is no such thing as a one-size-fits-all, so some people will be left out. Critics argue the CFPB is too powerful, drives up costs, and isn't essential. They believe shutting it down could reduce business burdens, increase competition, and make financial services more accessible and affordable. So how will this impact you? If the Consumer Financial Protection, the CFPB, shuts down, here are some things to consider, keeping in mind that this might not be as bad as some people fear. Much of this is over-politicized and exaggerated, often for clicks, views, and to distract us. Consider that some states have their protections. Various states have enacted or are enacting bans and restrictions on certain fees, offering some state-level protections. This means the CFPB may not be necessary. Remember, things might not change much. Some experts think that even if the CFPB shuts down, many financial companies will continue to follow the same rules they do now. If the CFPB is shut down, it could make it easier for lower-income people to get the financial services they need and open up competition among third parties. The White House may be using the threat of shutting down the CFPB to get budget deals and compromises. This is more in line with how Trump does things. Much of what he does is to negotiate. Some of this will depend on what the overall outcome of what DOJ finds during its investigations of waste fraud within the governmental agency. The director of the CFPB could be replaced with someone who wants to reform and operate the agency instead of deleting it. The CFPB's broader mission could shift dramatically from aggressive enforcement actions to a more collaborative approach with industry guidance and education over penalty. The only significant problem for the housing in regards to the CFPB being shut down is that it could increase the risk that we could see a 2008-like crash as a result of lower regulations. While the CFPB was installed as a result of the 2008 crash following the Dodd-Frank Act, this doesn't mean we will see anything like that again. We as a country have learned from this, and the environment is much different now than it was then. That also suggests that the other agencies that already exist are not capable of fulfilling these regulatory positions. The rest of the arguments on housing I don't find very compelling, mainly because I'm not certain the CFPB is necessary, at least not any longer. Following the 2008 crash, it was a good idea and it may have served its purposes. Personally, I tend to lean towards smaller governments and limited regulations. I believe there's reasons for regulations to an extent, but it has to be controlled. It has its place, but if not kept in check, government agencies can become like a cancer, growing out of control and destroying more than they can actually help. They don't function like a private company where the goal is efficiency and prioritizing outcome. Government's only priority seems to be about growing itself, oftentimes even corrupting itself. There needs to be regulations on regulatory bodies. And how efficient can that possibly be? I really want to see the outcome of the DOJ investigations of multiple agencies like the CFPB before I can provide a strong opinion overall on what might be the outcome for the housing market. I am glad they are looking at this, whether shutting it down completely or not. I'm not 100% confident yet. I do appreciate the idea of having an agency that consumers have a place to go to when things go wrong, but I'm always worried about them going too far. So what do you think? Do you think the shutdown of the CFPB is going to have a major impact on housing and housing costs this year? Would it make a big difference to you individually if it did get completely shut down? Let me know your thoughts in the comments. The CFPB is only one element in a larger plan for Trump to help the economy and to help the housing crisis that we're all facing right now. If you want to learn a little bit more about what some of those other items are, check out this video right up here. If you have any questions, all my contact info is in the description. Drop me a quick message or feel free to ask in the comments. I try to answer as many questions as I can. See you next time.